Who decides whether interest rates go up or down? Interest rates are a key indicator of an economy's health and performance. These rates determine the amount a lender charges a borrower for capital to open businesses, purchase a home or vehicle, or access cash. Whether rates go up or down depends on the Federal Reserve, the central bank who sets interest rates. When the Federal Reserve meets, they decide whether to raise or lower interest rates. So what goes into this decision? It's not as simple as changing the number on the interest rate sign outside your bank, but it's not exactly rocket science either. The Federal Reserve Board of Governors has 14 members who are appointed by the U.S. President and approved by Congress to serve 7-year terms. When interest rates go up or down, it's usually because the Fed decided to raise or lower them to try and influence economic conditions in America. The Federal Reserve. Inflation is the rate of increase in prices for goods and services and is an important measure of economic performance. When inflation is high, it can lead to higher interest rates, as lenders need to protect their profits from the falling value of money. Economic growth measures how quickly an economy is expanding or shrinking. If the economy is growing quickly, then the Fed may raise interest rates to slow down the pace of growth and avoid potential problems such as high inflation. On the other hand, if the economy is in a recession, then the Fed may lower interest rates to encourage lending and spending. Employment figures are another important factor that affects interest rates. High unemployment can be a sign of an unhealthy economy, while low unemployment indicates that businesses have more customers and need to borrow money to keep up with demand. The Fed will adjust interest rates accordingly to help maintain employment levels. When considering all these factors, the Fed will decide whether to raise or lower interest rates. Interest rate decisions will often affect mortgage and other loan rates, as well as the stock market. It's important to pay attention to changes in interest rates so you can adjust your investment strategies accordingly. The central bank. When setting interest rates, the Federal Reserve considers a number of factors. These include the rate of inflation, employment levels, production capacity, and international pressures. By carefully analyzing these factors, the Federal Reserve is able to determine what the best course of action is for interest rates. It is important to note that the Federal Reserve does not always make decisions in isolation. They often consult with other government entities, such as the Treasury Department, before making their decision. The bottom line is that when it comes to interest rates, the Federal Reserve has the ultimate power to decide whether they go up or down. It is important to understand how the Federal Reserve determines interest rates so you can better prepare for whatever changes may come your way. The economy. When it comes to the health and performance of the economy, interest rates are a major indicator. But who is responsible for setting them? This is the job of the Federal Reserve, the central bank of the United States. Raising interest rates can be beneficial as it encourages people to save money, while lowering them can help stimulate spending and spur economic activity. A higher interest rate also makes it more expensive for companies to borrow money, so they may be less likely to invest in new projects or hire more workers. This can lead to slower economic growth in the long term. On the other hand, lower interest rates can make borrowing money cheaper, so businesses may be more inclined to take on new projects and hire additional workers. This can lead to greater economic growth in the short term. Ultimately, it's the Federal Reserve's responsibility to weigh the different factors when determining the best course of action. It's important to remember that this decision can have lasting effects on the economy, so it's essential that it is made carefully and thoughtfully. Interest rates. The primary factor taken into consideration is inflation. If the rate of inflation is high, the Federal Reserve may decide to raise interest rates in order to slow it down. On the other hand, if inflation is low, they may decide to lower rates in order to spur economic activity. Finally, the Federal Reserve considers global economic conditions when deciding on interest rates. If the U.S. economy is stronger than other economies, they may choose to raise rates in order to maintain balance in the global financial markets. Conversely, if global economic conditions are weaker than those of the U.S., they may decide to lower rates. Ultimately, the Federal Reserve's decisions on interest rates have a significant effect on economic performance and stability. By carefully monitoring economic indicators and global economic conditions, the Federal Reserve is able to make informed decisions about whether or not to adjust interest rates. What is the effect of the high rate on the markets? The level of interest rates plays an important role in the health of the economy. When interest rates are high, consumers are less likely to take out loans for things like purchasing a car or a house. This lack of borrowing can slow economic growth and can lead to deflation. Low interest rates, on the other hand, encourage borrowing, leading to increased spending and economic growth. In order to control inflation, the Federal Reserve sets a target interest rate based on their evaluation of current economic conditions. By setting a target interest rate that is higher than the current market rate, the Federal Reserve can help to reduce inflationary pressures. On the other hand, if the target rate is lower than the current rate, it can stimulate spending and help fuel economic growth. In addition to targeting a specific interest rate, the Federal Reserve also uses a variety of monetary tools to keep inflation in check. These tools include raising or lowering reserve requirements, buying and selling government securities, and raising or lowering the discount rate. By carefully adjusting these tools, the Federal Reserve can create an environment where prices remain stable over time and economic growth is encouraged. The United States Department of Treasury determines whether the Federal Reserve changes interest rates by giving them suggestions about what should be done. There are some who argue that private banks should be allowed to determine how much interest they charge because then we would have more choices when determining how much money we want to make. How does it affect all the world? The most immediate impact of a change in interest rates is on inflation. Inflation refers to the rate at which prices for goods and services increase. A decrease in interest rates encourages people to borrow money for purchases, which can lead to an increase in demand for goods and services and result in higher prices. On the other hand, an increase in interest rates causes people to save rather than spend, which can lead to a decrease in prices. The effect of the Federal Reserve's decision on interest rates also extends beyond the United States. Other countries often look to the U.S. for cues about their own economies and decisions about their own interest rates. For example, if the U.S. increases its interest rate, other countries may follow suit with increases of their own to remain competitive. Similarly, if the Fed decreases rates, some countries will likely follow suit by decreasing theirs as well. Changes in U.S. interest rates also have an effect on global stock markets since investors want to know how different parts of the world economy are doing before they decide where they should invest their money. So what does this mean? It means that when you think of interest rates, you might not only be thinking about what it means for your bank account, but you're thinking about how it affects all parts of the world. If you enjoyed this video, please like, share, and subscribe.